Okay. Down to serious business time. Who's ready? Raise your hand, make some noise. So in this session, as I promised, we're going to go through how to get started, 8 ways to come up with some money to be investing or come up with more money, because it's critical when you look at investment strategies, you have access to some capital. Some strategies will take more capital than others, of course. I'm going to go through, as I said, about half a dozen stock market strategies, a couple of them in detail. You'll leave this session before dinner knowing how to rent shares, as an example. I know many of you want to learn that strategy, so we'll actually do that. We'll touch on insuring your shares as well. I'll also go through a global economic update and the importance of that, what's going to happen in the economy or what's likely to happen, and how that affects you as an investor as well, because I think that's important. I'll touch on the property market as well, my views on that. But first of all, what I'm going to run through with you is, I guess, what we call the financial blueprint. So jot this down. This is very critical. And this is what you'll come back to. So the financial blueprint we've taught for 12 years now at 21st Century is effectively this. What we're looking at is jot this word down. The word we're after is, some people say, well, Jamie, how did you accelerate your results? How did you compress what normally would take decades to create wealth in a shorter period of time frames? A lot of people like to know how to do that. Well, one of the ways I was able to do that, I did something that was fairly unique, that is now much more common. But I did this. What I used was a combination of strategies, and I combined them together. As a result of that, it sped up the process. So the word we're actually after, if we want to be able to become wealthy faster than usual, the word we're after is synergy. What's the word? Synergy. So what synergy basically means is 1 + 1 equals what? 3. Yeah, it equals more than 2. In other words, by combining some strategies together, we can accelerate the results and get there faster. So if we look at where you can invest, most people will start off with a job. Okay, if you don't have a job, where should you start? Getting one. With a job. A lot of people go, well, I'm not going to worry about a job, I'm just going to become a full-time investor. No, generally you'll get a job and then you'll become an investor on the side and you'll earn the right to quit a job. Does that make sense? That's the way to do it. Otherwise, generally it doesn't work the other way around. You've got to have cash flow or some capital behind you to become an investor generally. So a job is going to help you do that. The most common way that people in Australia have become wealthy over the decades is this. They learn how to save money. They take their surplus cash flow from their job and they invest it where? Into a house, into property, generally into their own home to start with. And over a period of a decade or several decades, what happens to the value of that home? It rises generally in value. Okay, generally doubles, every 7 to 10 years has historically happened. Varies depending on city, location, type of house. But if you're not sure about the property market, you can go back and say, in a capital city, say in Brisbane or Melbourne or Sydney or Perth or Adelaide, and then you can say, well, 10 years ago, what are house prices today on average? What were they 10 years ago? What were they 10 years before and 10 years before that? When you see that, actually tonight, when Conrad speaks to you about property, I'm sure he'll show you some of the graphs of cities, so you can actually see houses that were like $12,000 you could buy it. Then doubled in 10 years to 24, and then 48,000, and 100,000, and then 200,000, 400,000, 800,000, 1.6 million. Does it make sense? That's what tends to happen as the decades have progressed on. So if this is all we did, was to, instead of just working for money, learn how to invest and have money work for us, and just done that strategy, bought a home, over a long period of time in Australia, you would end up a lot wealthier than people that just work all their life and don't invest whatsoever. Does it make sense? Yep. Then what would typically happen, people buy a home and then they will leverage against that home to put a deposit down on some investment properties. And we call what we call leapfrogging. Who's been leapfrogging over the years? Where you leapfrog into one investment property and then into the next and the next. And that can work quite well. Okay, at creating wealth. There's a few challenges in the short term because it burns cash generally, because most properties in Australia are positive geared or what? Negative geared. Those who are not sure what negative gear simply means, it means that after you, let's say you borrow for a property, And you've got to pay the interest, the mortgage, right? Well, you put a tenant into the property to cover that. But sometimes with the tenants, not enough rent being paid to cover the mortgage, so there's a negative shortfall. And after tax benefits, there might still be a negative, which means you have to top up the amount to cover. So it's negative gear. A positive gear is when the rent is higher than the mortgage. So therefore, it doesn't cost you any money. We're going to look at tomorrow, US property as an example, highly positive gear, okay, different to the Australian market. So if that's all we've done, that's created a lot of wealth for Australians with our very good property market that we have here. Then what I learned was a thing, not straight away, but several years later, was I learned a concept of share renting. It was a terminology that I created, but that concept. And what I learned is that my mentor said, Jamie, you want to consider this as a strategy because you're doing well. See, I was focused here on the property predominantly for capital growth. Most people in the stock market, traditionally, what do people look for in the stock market? Capital growth or cash flow? Well, most people, when they'll traditionally buy stock, they buy and hold. Is that true? Which is capital growth strategy. So when I was introduced to the stock market, I was like, nah, I linked pain to it because one, might seem more difficult because I didn't know anything about it. Two, I had preconceived ideas. And three, I was thinking like, I'm already buying real estate and that's working well for me. Buy, hold strategy, real estate seems to work quite well for that. Is that true? Buy, set, forget, let it rise in value over time. Shares, yeah, not that as simple as that. But then I was thinking, why would I want to buy shares to create capital growth when I've already got something that's really working for me? So that's why I wasn't interested in shares. It wasn't until my mentor said, you know what, you're looking a different way. Most people do the opposite to most people, remember? Most people in the stock market for capital growth. He said, that's much harder to do. You can't do it, but you already got that working for you. What you're after is cash flow. So go on the stock market for cash flow. You'll actually make more money than the punters that are just trying to make money out of capital growth and get your capital growth from real estate because you're more likely to succeed there in capital growth. True? So what we're just doing was being smart and stacking the odds in our favor. So I went into the stock market to the opposite of what most people go in it for. I went in for, as you know, for cash flow. Does that make sense? So I looked at strategies that could generate monthly income because the properties were great for capital growth, but you couldn't live off it in the beginning. You're making money on paper, but to live, you need to convert that money to cash. So what he said what you could do is by combining these two strategies together, you could draw out equity, a line of credit, and put some money not only in other properties, but you could put it into share renting as an example, generate some cash, and then you can fill that cash back in to buy more properties. Makes sense? So then you could do this in a cycle. And as a result, what it meant, instead of waiting 10, 15 years for your properties to be paid off from the tenant, etc., you could actually speed up the process. So why these properties in the beginning were going up in value, you could start generating monthly cash flow and turn that equity into monthly cash flow. So now you had becoming asset rich, but also cash flow rich. So instead of waiting way down the track to get the result of having the cash flow, you were able to bring and shorten that period of time frame to where you got the cash flow from your turbocharged portfolio. Does that make sense in a concept? Now, when that was first become more common knowledge to people, that was like seen as a breakthrough investment strategy. Now it's fairly common. A lot of people teach the share renting principle that I termed, and it's becoming more mainstream. But before, remember, in the past, property investors didn't touch shares. Is that right? It was like you either like a Holden or a Ford. You never liked both. And that was the way it was. Or stock market investors never touched property. So it became like the idea of putting them both together and using them together was like a unique type concept. But you can see the benefits of doing that. So the other thing that to build wealth is obviously to build businesses. And so a lot of people go from their job and they'll turn their job into a business. You might want to add that one in there because this is really the only ways to create wealth. Business, property, stock market. Okay, nearly all investments fit into that criteria. Is that true? And what is stocks? They're a business. Very large businesses. I mean, you can invest in art and things like that. but most investments will fit into here, okay? All derivatives of the stock market or Forex market. Make sense? So what a lot of people do is this. Here's the common mistake. Would you like to know what the common mistake is that people make with their financial strategies? Yep, so here's what it is. Very common mistake is everyone's focused on, they're going like, Jamie, I just want to, I want to be able to quit my job as quickly as possible, so I want to make some money from here and here, so I can quit this. And they make that jump too soon or want to jump there too soon. The fastest way to get out of your job or have that freedom is actually to ramp this up. Because what helped me speed up my process was I dramatically increased my income. Remember, I negotiated a contract up front, performance-based, where I was working for my mentors' companies, and as a result, I boosted my income. That enabled me, one, to eliminate debt faster, using debt reduction strategies. It enabled me to have the cash to fuel my investment strategies. If I didn't grow this and neglected that and then cut this off by quitting too soon, then I would have slowed this down. What you want to do is use all strategies available, not everything, but use more than one, but certainly don't neglect your job. So the mistake people do is they don't focus here enough and they just start focusing over here. What you want to do is use the strategy I talked about today, the time-rich stuff, negotiating a pay rise, freeing up more of your time to boost this. Then consider what we teach in the internet and business home study or the internet program. We'll probably do another one next year we'll let you know about. If you want, a lot of people then will build up a side income, like build an internet business or something like that. So they're getting an additional form of income. For some people, people love that, okay? It's a skill set, not easy to do, but if you understand the skill set, people have done very well from that. And so they start to get maybe a second or third form of income and passive income. And they take this income and pour it into their strategies. Is it making sense? So we don't want to neglect here. Sure, we want to have money here. We want to have money here ideally. You don't have to do both, by the way. You might say, Jamie, I just love properties, work well for me. That's what I want to stick to. Yeah? Or you might say, actually, good idea. I'm going to learn how to do this as well in conjunction with property. Or now what we do is say, okay, let's get a little bit more sophisticated. This blueprint has worked well for 12 years. But earlier this year, I made some amendments to it. And I did a video blog on this. If you follow my blog, keep you updated of a lot of things. Or on Facebook, they'll post links to the blog. So what I said, predominantly, imagine 21st century members 10, 12 years ago. They got out there, come to a seminar, and said, this is great. Yep, I'm going to go and buy some investment properties. And they'd gone out and done that. 12 years later or 10 years later, would they generally be pretty happy if they went out in the marketplace and they were motivated at an event like this to get their butt into gear, get organised, and they go out there and buy a couple of properties? Would that be a good thing for them? Many of them are millionaires today as a result. There's everyday people, but as a result, they got out there and bought a few properties, and those properties have doubled in the last decade. As a result, they become millionaires, or certainly well towards that. Okay, so it was fairly simplistic. Really, all they needed was actually to do it. Okay, maybe a little bit more education so they learn how to do it, but overcome their fear and just get out there and do it. So a lot of people did that. Okay, and as a result of that. But today, you say, well, Jamie, that's all right for people 10 years ago. What if I'm just starting out now? What's going to happen in the property market in the next 10 years? Australian properties, are they going to double in the next 10 years? What's going to happen? Will it be that simple? Will it work that way? Well, these are all valid questions. Is it true? Who has these questions? So what I'll share with you, I guess, I'll give you what my viewpoints are. I mean, obviously, and then we will look at what's most likely to happen, and we can consider that. First of all, no one has a crystal ball. If someone professes they do, well, we'd like to see it. Warren Buffett does not have a crystal ball, but he's worth $35 billion. Why? Jot this down. He's a contrarian investor. Contrarian means see what most people are doing and do the exact what? Opposite. Contrarian investor. He's also a fundamental investor. He follows the fundamentals. And we'll talk a little bit about that later. Okay? So, as far as what's going to happen in the economies and what's going to happen with the Australian property market, what we decided to do is, a year ago, whatever, say, well, let's amend this financial blueprint slightly. This is what I would now do differently, and this is what I do. It's up to you what you'll do. So a few amendments that we made. One, I said about a year ago, well, let's go back to 2008. In 2008, the credit crisis hit the world, and the world went into panic. You remember the day probably that Lehman Brothers bank went broke, and that was really the catalyst to send the world's financial system to the brink of collapse. It was within 48 hours of collapsing, the world as we know it. People are probably unaware of how close it come to complete catastrophe of turning into worldwide depression. We're talking a matter of day or hours from holding the system together before a total meltdown. That's how close it come. And of course that sent massive panic, because jot this down, what the markets don't like is surprises. Does that make sense? You'd understand that. The markets do not like surprises. Lehman Brothers going broke, was that a surprise, yes or no? 118-year-old bank. If they can go broke, and then before that, Barings and almost, not Barings, whatever it was, Bear Stearns, had been gobbled up, and a few of the other smaller ones were really shaky. So it was like, my God, if these large investment banks or boutique banks that have been around for 100-odd years are collapsing, then all the banks freak out and stop loaning money to each other. Okay, and to stop loaning money, there's no liquidity, there's no loans. Our whole system, a financial system, won't work unless people have faith that they'll loan money to another bank or loan money to a business and they'll get it back or get most of it back. If that freezes up, as we see in Europe right now, many US banks and global banks won't loan money to European banks, so they're finding it harder and harder to get money. So the system is all based on confidence. It's all based on perception. As many of you would know, that the Federal Reserve in the United States is not actually a federal body. Okay, it's owned by private individuals, private banks. So who's the most powerful person in America? Is it the president, or is it the president of the Federal Reserve Bank? Through the credit crisis, the power is completely in the Federal Reserve Bank. What are they going to do? The president has less power, okay? Because what's one of the most sought after commodities on the planet? Apart from oil and apart from actual commodities. What is the most valuable thing? What do you all want? What are you here for? Cash, money. So if you can control the supply of money or issue money, are you not very powerful, yes or no? The Federal Reserve is the only organization really that has the power worldwide to issue money at will, to print as much as it wants. And that's what it's been doing. Massive power in the hands of the Federal Reserve, which is owned by private bankers. Okay? We have a debt-based financial system, and we won't go into what's good about that, what's not good about that, and the problems with that, but you already see the problems. A debt-based system is not sustainable, and that's why it keeps the challenges that we have in the world today is based on too much debt. So in 2008, the credit crisis hit. There was a gentleman in Australia, Professor Stephen Keen. Some of you are familiar with, professor in Sydney. He came out on the radio and newspapers and said, Australian house prices are going to collapse 40%. He was so certain of that, he sold his apartment in Sydney. And he even made a bet that if it doesn't happen, he will walk naked from Canberra to Mount Kosciuszko. Okay? God help us. Now, he was a professor, intelligent man, academically at least, but was he a successful property investor? No, because that wasn't his experience. And he was basing his theory or hypothesis on what had happened in the United States and what happened to the UK. And we've seen in the United States, property prices did crash, up to 70%, you'll hear tomorrow. On average, 30% across the board. You see in the UK, property prices crash. So they go, okay, well, that's happened there, it's coming to Australia, it's going to crash the Australian property market. This is 2008. I was one of several people and others that didn't agree with that assessment. I went into some radio shows at the time and said, you know what, I don't believe it will happen. I don't have a crystal ball, but I am a property investor, and according to my fundamentals, it's not going to crash 40%. Actually, I said I'm willing to state that I bet the property market rises 20% before you'll see any correction. Now, that was very bullish in 2008 because people thought the world was coming to an end there for a while. But fast forward 2 years later, 2010, and you saw places like Melbourne rise 18%. There was actually quite significant. Sydney started to rise. Okay, other cities like Perth and Brisbane not so much because it already had risen before that. So why was I willing to say that when Professor Stephen Keen and others weren't? Well, here's the difference. Let's see if we can figure this out. You don't have to be an economist to understand this. Jot this down. This is what you've got to understand. Common sense. If you want to become a millionaire or billionaire, that's all you have to understand. Let's see if we can figure it out. Common sense. Okay. Let's look at fundamentals. 2008. Okay, Australia. Was the population of Australia A, decreasing, B, staying the same, C, rapidly rising? C, you know that, rapidly rising. Okay, let's see if we figure this out. If the population of a country is rapidly rising, A, will that cause the property market to crash? B, cause it to rise? Or C, at least cause it to stay, keep a ceiling underneath it? Or D, B, and C? D. Okay, I'm making it way too easy for you guys. Do you see the point? It certainly would not say, well, rising population, rapid growth. I mean, we had 346,000 immigrants in just 1 year, record high immigrants to the country. It's a lot of new people in this country for a country of less than 24 million people. So that would say, nah, that's not going to make it crash. It doesn't mean it'll make it rise, but it'll at least keep a ceiling to some level under the property market. Okay, let's look at other factors. Interest rates. In the credit crisis, did the banks, A, rise interest rates rapidly, B, keep them the same, or C, drop interest rates rapidly? Who says C? Correct. They dropped them rapidly. Okay, let's look at that then. Will that cause property prices to, well, let's figure. Will that cause, if interest rates drop down rapidly, does that mean people's mortgages is now easier to pay or harder to pay? Easier to pay. Therefore, will that cause people to not be able to afford their repayments if interest rates come down? Yes or no? It'll make it actually easier to meet the repayments. Is that true? So that's not going to cause the property prices to crash, is it? It's, as long as the income stays the same. This will come next to employment next. But interest rates, okay? Interest rates going down is actually, and we complained about the recession we didn't quite have, 2 years ago. But actually, one benefit was our interest rates dropped. Is that true? Everyone benefited from that in Australia. So it was like, well, that was a positive out of it. So that wouldn't cause property prices to crash. Now, it doesn't mean property prices won't crash. It just means fundamentally that's not going to be the cause of it. Okay, let's go to unemployment. So in 2008, did we have let's say, rapidly rising unemployment, B, moderately rising unemployment, or C, you're not really sure? B, moderate. You'd say moderate. We don't say rapidly rising. 10% in the US, rapid rising high unemployment. In ours, we did rise, I think, to 7% from 5% or a bit below 5%. Moderate. Most countries would have loved only 7% unemployment. So we did see a rise in unemployment. It was more from the fear factor of the global problems, the US problems. People freak out. Employers go, shit, I better start downsizing. It's a self-fulfilling prophecy. Consumers stop spending. Consumers go, shit, the world's falling apart. Let's just not spend anything right now. Let's just put the money in the bank and see what happens. So as a result, it creates a shock to the system. And the people go, shit, start laying off people. And that's what started to happen. So, however, unemployment rising, does that mean property prices will fall? It's a more difficult one for you to figure out, okay? It can possibly, if it gets too high, you would say, well, that could affect the property market, true. But let's go back into history, shall we? Always good to check the past. The past gives you clues about the future, remember? Last recession, the recession we had to have. Do you remember that one? Mr. Keating's recession. 1991. Rising unemployment, 1991. Did that cause house prices to crash, yes or no? Didn't. House prices continue to rise despite that. Knowing that, it doesn't give you a clear signal, but you go, hang on a minute, that doesn't give you a clear signal to say prices will crash. It actually could mean that it doesn't affect prices or only moderately affect prices. So we're still fundamentally not the papers or Stephen Keen saying it's going to crash. My God, it's going to crash. But still, we're not seeing any evidence to say it should crash in 2008, fundamentally. Okay, let's go to the supply side, shall we? Supply side of construction. Does Australia, in 2008, did Australia have a housing shortage, yes or no? Australia was producing, I think, they needed about 180,000 homes for the year. They produced, I think it dropped below, correct me if I'm wrong, about 135,000 homes. They were somewhere around close to 50,000 homes short. So the amount of homes in 2008 when the banking crisis hit, did that mean A, it's easy for developers to get funding, or B, almost impossible for developers to get funding? B. Therefore, does that increase the amount of developments developers can build, or B, does it decrease it? Decrease it. See, how common sense is this? It decreases the amount. So we have 180,000 homes we need. They were doing about 155,000 in 2007. 2008 hits, they can't get funding, they drop back to 134,000. So the gap of amount of homes needed is increasing, so the demand for properties is increasing. Demand for limited properties, what should that do to prices? A, cause them to crash. B, cause them to stay at least neutral or moderately grow. Or C, potentially rise even faster. It'd be B or C. You'd say it could potentially cause them to rise faster or at least put a ceiling under that. And that's what you're looking for. And actually, you dissect that and go, in certain areas, you'd expect it to rise fairly decent rises. In other areas, where it's already had some rises like Perth and Brisbane markets, maybe not so much. And that's where, for those who knew about property markets, you would have identified Melbourne then as a city that was likely to rise. Why? Because the cities go in cycles. Did you know this? Which is the first city to take off generally in Australia when the property market takes off again? Sydney. Well, I would say it's generally Melbourne. Sydney, close, but generally Melbourne. Why? Who cares why? It just is, okay? Which is the last city to boom generally? Well, technically you could be right there. One day it might. It's Perth. Do you realise that? As far as large cities, Perth is generally the last city to boom. So when we're going through the property flat period for a number of years, okay, especially in Sydney and Melbourne had flattened out, slowed down. Perth continued to rise from the mining boom, etc. Perth got to the top. Okay, the others had been fairly stagnant or slow growth. And Perth struggled, stopped rising and even fell back in some areas. And then it come back around to Melbourne and then Sydney. Okay, rose again. Okay, now Melbourne's slowing down a little bit. Okay, but it's always been a good city. Now, the other thing that's helped cities like that is because it's been growing in a faster population. So with population growth, which cities are growing faster than others? Brisbane and southeast Queensland used to have a lot of interstate migration. But if you look in the last few years, one of the reasons why property prices haven't been as strong up here is because the interstate migration has almost come to a stop. Do you realise that? There used to be so many Victorians leaving Melbourne to come to the Gold Coast or Noosa or Brisbane. It was like last one leaving, turn out the lights. Remember? Back in Mr. Kennard's days. But that's changed now. Queensland is not attracting much interstate migration. Also, out of all the cities in Australia, these are handy things to know if you're going to become a property investor. Out of all the cities in Australia, which city attracts the most immigrants? Melbourne. Do you realise that? Sydney has been overcrowded for a decade or so. It's too big. It's hopelessly managed. It's had a poor governments, okay, poorly managed, where Melbourne had much better governments. They had Jeff Kennett, whether you loved him or hated him, if you're not from Victoria, you don't care. But he really fixed up the roads and made that city happen. And Sydney is lost city, okay? Melbourne will continue to boom and Sydney will struggle because it's just so big and they haven't put the infrastructure in, they haven't done the hard yards. So Melbourne attracts because Melbourne's cheaper to live, is that true? And there's a lot of jobs. Sydney has a lot of jobs, but it's too expensive to live. That's why Brisbane used to took off in the past. That's why Perth, because people could remember, but Perth become the most expensive city in the world. Perth, people used to move there because houses were half price, remember? Now it overtook Sydney at one point. It's come back a little bit now, but it become more expensive than Sydney. So those factors start to change the city and where people move. Okay, so that's when you break it down a little bit more. But let's just keep back to the fundamentals. So as a result of that, is there's not enough houses being built. The banks won't lend developers money in a credit crisis. Therefore, does that suggest property prices will crash, yes or no? It doesn't. And we suggest, well, that doesn't give any reason why it should crash. Therefore, common sense would dictate, if Stephen Keen was saying that in 2008, you go, hang on a minute, it's just not making sense. What is he basing his analysis on? Well, he's solely basing it on the US and UK. Okay? And in the US, did the US have a massive oversupply or undersupply of property? Massive oversupply. They allowed after 2001, well, first of all, they had the tech crash. Remember the dot-com crash? That hurt the economy. Then they had 2001, which they were scared was going to destroy the US economy. So what they allowed, and back in, as far as the credit crisis, what they allowed to happen is that, well, a few things that caused the credit crisis, but one, as an example, is when the dying days of Bill Clinton's presidency, they had him pass a bill. It wasn't his idea, but pass a bill that put into law where banks had to loan X amount of money to those less fortunate, those that generally couldn't afford a house. So it's really out an idea of trying to do good for people, but it was really a foolish idea. And so the banks and lenders had to loan X amount of percentage of people to people that generally couldn't get a house. Now, people couldn't generally get a house. Is there a reason for that? You don't have a deposit, don't have a reliable income, etc. So there's a good reason they can't afford a house. And also the government allowed, and the banks allowed, to have lax lending standards because they thought, well, it's safe as houses. People can borrow, house prices are going up. Okay, we'll keep easy lending. If they're going to go up, so the banks weren't too worried because they always assumed the property prices would go up. And then they created these credit default swaps and all these mortgage-backed securities, which sounds really secure, backed by a mortgage of US property houses for the last 150 years have always risen. So they sell it worldwide to investors. But a lot of these loans were being made to ninja loans, no idea, no job, okay? So there was stories in San Francisco of people on the street, homeless people, signing mortgage documents and be given a brand new house. They would do these fancy loans. They got so clever how to lend because they're like, shit, let's just lend more and more money. There's so much money in this. Let's do these honeymoon loans where they pay like 1 or 2% interest for the first 2 years. And then it jacks back up to high interest rates after that. So anyone can afford it for the first 2 years. All these were written. So all it was doing, this is where John Paulson and people like that were in America recognized, hang on a minute, if all these loans are out there being written where they don't pay much for the first 2 years, what's going to happen when these loans reset to the high interest rate in 2 years? That's how some of them predicted the property crash would happen in the US. And John Paulson made like something the first year, $3.5 billion, $5 billion the second year. He's worth about $15 billion, made most of his money by a simple bet that the US property market was going to crash. Now, if we had been in the US market knowing this was going on at the time, we could have probably come up with the same conclusion. It's going to reset. There's going to be a major turnaround and prices will fall. I remember being with a friend of mine. He's owned about 1,000 properties in the US. He bought them in the 1990s. And this is probably about 2005, 2006. The property market in the US started crashing. August 2006 was the peak of the US property market. In about, not long before that, we were with a peer group of people from the United States. And I remember him saying to some of my US friends, he said, you guys are crazy, because what they were doing, see, here's when you get worried. When your taxi driver is becoming a property developer, get out of the property market, okay? When your taxi driver is giving you stock tips, get out of the stock market. It's called the taxi driver test. Basically, when everyone's becoming a property developer or anyone's getting a property investor, get out. When everyone's becoming a stock market investor, get out. Because when the masses rush in, they're usually too late. You want to be ahead of the trend, true? Be ahead of the trend or create the trend. So, where I was up to? So what he did, he told some of these other guys, he said, you guys, what they were doing is that they'd buy a house, a property, anyone could get credit. It was so easy to get credit. And they were rising, right? So everyone would quit their job in the US, they'd quit their job and just become property investors. And they'd buy another house, and they'd be living off the line of credits. And even all Americans, what they did is they increased their line of credits. Everyone could get loans, and they took the money out, bought another car, went on a holiday, lived off it, worked less. So all this consumption was going on, the economy going in the short term, but people were getting so indebted. And he said to me, he said, you guys are crazy. There's going to be a property correction, and you are going to be underwater. In other words, underwater means, let's say you have a property portfolio worth $2 million and you owe 1.5 million, but the property market crashes and it's now only worth $1 million, your property portfolio, but you still owe 1.5 million, you're underwater. Is that true? You're upside down. You're drowning underwater. And he said that's what's going to happen. He started selling his property portfolio back in 2005. Smart guy. And my other friends didn't listen. And they paid the price. I know many multi-millionaires in the US that lost everything. Can you imagine being worth 20 or 30 million and even in cash and losing it all and going back and having to start again? See, that's harder to deal with than if you're just broke all the time. Become rich, then go back to being broke, that's a problem, okay? Because now you had a taste of it. Now, many of them turn it back around because they just know, they can, but it's a lesson to remember. It's a valuable lesson, and that happens to a lot of people in America. Now, guess what my friend in America is now doing at this point in time? Buying. He's bought, last time I got up with him, he bought about 100 more houses in the US. He's back in buying again. So that's just, he's smart enough to predict a trend, but really all they're doing, like all Warren Buffett, now Warren Buffett's been buying US property. Donald Trump was out here a month or two ago. What did he tell people? You should be buying US property. Harry Dent was out here saying, guys, you should be buying US property. John Paulson, the guy that made the bet that the property market would crash and made all those billions of dollars. When I was in the US in May, he said clearly, anyone that's not buying US homes is an idiot. And he's the guy that made billions of it crashing. Because they've seen it where it was up here, where everyone was rushing in, happy to buy, and then when it's come all the way down here, everyone's too scared to buy it. It's crazy, isn't it? They don't want to touch it. But people can go and snap it up, okay? So a lot of people, that's why I've been buying US property. Now, some people go, well, Jamie, but you don't understand, the US dollar is going to crash, and the US economy, it's starved forever. I'll talk about that later, how we're not stupid. We factor that stuff in, we can still make a profit. There's no crystal ball, there's no guarantees, but if you understand things, you'll know where there's opportunity. Okay, and we'll talk about how that relates to the Australian. I did an interview last week actually for BRW on the same topics of Australian versus US property. What are my views on that? And it's similar to what I'm sharing with you now. So I'm obviously bullish on the US property as a clue. So most of you should know that. I've been telling people that in my blog for some time. Why? Because I can get 10, 15, 20% net rental return, so positive cash flow. So what we did to amend this, what I now do in my strategy, now this is up to you what you do. I'm just saying in the financial blueprint that I've been doing for years and how I've amended it. So now what I've done is I add US property to my portfolio, so as one strategy. Why? Because it balances my portfolio, I get cash flow. I'm buying it predominantly for cash flow. I don't care if I never get any capital growth on the US market. I believe I actually will, and I'll tell you why in a moment, but I don't need to. I don't need to. And I'll also tell you how you can profit from a Forex trade by buying US property as well, okay? My views on the Australian property, that's where we're heading to. So obviously in the US market had a massive oversupply of property. Was the US population growing as rapidly as Australia's as a percentage or less? It was growing less. It is actually growing. The US population is still actually growing. So here's why I believe in the US there will be some short-term gains to be made on some US property. I'll just touch on that quickly. Is because in the US, was massive oversupply. They're starting to get through the massive oversupply. It'll still take quite a few more years yet because all the big hedge funds are now buying all this US property very cheaply because the banks don't care about property. They'd rather lose money on a property and just have their accounts fixed back up so they can lend more money than sit on property that they could probably sit on and recover money from after time. They just want to get rid of it. Even here in Australia. You say, why don't some banks just sit on the houses and wait till they rise again and then sell them and they make a profit? They're not interested in that because if their mortgage is in default, then they can't loan out as much money. They need to even take a loss, get rid of that loan, and that's why they'll foreclose on people, and then they can issue more money because banks make more money from issuing money than they ever will out of property. Okay? If they thought they could make more money out of property than they do out of issuing money, they would be in the property business. They're not. They make a lot more money. They make money out of having you guys buy property and selling you the loan. Does it make sense? They're playing one level above all of us. So in the US, what will happen is, my prediction is this, is that if you can buy properties below replacement value, jot this down because when we go on the stock market shortly and talk about Warren Buffett, if you can buy an asset below intrinsic value, you'll always make money. Now, what's intrinsic value mean? I'll share that it's usually stock market terminology. It just means what its real value is. And I'll go into that when we go through shares. Here's an example in property. Let's say a US house was $250 at the peak of the market, say 2007. And let's say the house now you can buy, say, for $79,000. I'll give you some examples of some of these things tomorrow of what people have been able to do. And let's say this is in Phoenix. This is a typical city that you'll do that in. Let's say, though, the replacement value of this house to rebuild a similar house is $200 and say $25,000. Including the land. Okay? Let's say that's the replacement value as an example. Does this property have intrinsic value, yes or no? Yes. Because even though it's second-hand, it might be 3, 4, 5, 6 years old, so it's not going to be worth this new home that can be built for $225, but it's probably going to be worth, say, 20% less than that, or 10, 20% less. So let's say it's going to be worth $180,000 as an example, because it's not going to be worth as much as a brand new home. Therefore, that property in that example would have how much intrinsic value? $101,000 intrinsic value. So even if it never rose in value, you're still confident you bought an asset so far below what its intrinsic value, its replacement value is, then you feel more comfortable with holding an asset. So for me as an investor, I'm more comfortable holding an asset like, particularly because you're getting a cash flow return that will pay the property off in X amount of years anyhow. Making sense? If it was negative geared, be a different story. I'll go through some questions later. Making sense? Now, if the US economy just died, on a tangent here right now to cover this, if the US economy never recovers for 10 years, my belief is, jot this down, my prediction is, now we could be wrong on this, but it's always best to be conservative. So if I'm wrong, it's an upside. And I was talking to Harry Dent about this, he agrees as well. I said to Harry, my belief is this, the US economy will go into a Japanese-style recession. Jeremy, what does that mean in layman's term? It means that Japanese economy in the 1990s went into a decade-long recession. Does that make sense? And it still really has never recovered from that. It means I expect the US economy for the next 10 years not to recover. Okay, to not recover. And I'm still happy to buy US property if it doesn't recover in the next 10 years. Now, I think I could be wrong on the upside. Who thinks there's a possibility in the next decade the US economy may manage to recover to at least some degree? Yeah, I would say that's still a fairly decent bet. But if you're being super conservative saying it doesn't, because you don't want to go into a plan and go, I'm basing my plan that it will recover and hope it does, because then you're living in hope. I'm saying I'm basing a plan on if it doesn't recover, I can still make money. Now, if it does recover, make a fortune. But even if it doesn't recover, can you make capital growth still? If you wanted that in the US, you shouldn't be buying US banking on capital growth, but as a bonus. Then I would say yes, because here's what I predict. Within 2 or 3 years, the population in the US is continuing to grow. The housing industry, the housing construction industry has plummeted. They were making last year only 25% of the homes they made at the peak of the market. They're up to about 33%. So imagine they were making, let's say, I don't know the exact figures, I forget. Let's say they were making 3 million homes a year, okay? Now they're only making 1 million, 2 million less than what they used to. That means the construction industry, that's because there's not as much demand, but the population of America is still growing. Once all the surplus stock, all these foreclosed properties gets burned out, it gets tied up, will take a couple of years depending on the city, and they run out of foreclosures, then people that want a home have to buy a new home. So they have to start building new homes to meet the demand. The construction industry is not geared up to be able to build enough of the new homes because it's been decimated. It will take years to slowly build that industry back up because most of the business went broke. So there'll be a slack of several years. They can't build enough homes, so there'll be a push of demand. What it will do it'll push some of the homes with intrinsic value back up, not to the cost of a new one, but towards their replacement value. You'll never see the days where they get back up to here again. That would be highly unlikely. You'd have to be a gambler to expect that. But to get back towards here, does it make sense? Common sense can dictate that can be possible if America continues to rise. Now, there's other things as far as currency you'd have to be aware of, but we're not going to talk about US property right now. I'm just covering that as an example. If we're in a country where we want to now still profit from property because we love property as Australians, then we should certainly be considering our options. The question should be, if we can get better returns elsewhere, should we consider it? That's what you should do. I'm not saying you should. Now, the other thing that I get interviewed on is, the question is this: is the US property market a good idea for the average Australian or the average Kiwi? That's a common question. It's a fair question. My answer, would you like to know what my answer is to that? My actually answer is no. I don't think the US market for the average person is a good idea. Reality, being really honest with people, is that the average person has lack of education, don't really know what they're doing, and the time and the cost and to go to the US to check out property, to research it, to not get ripped off, to know what they're doing, is unlikely they're going to be successful. Because as soon as the US, even though the US likes Australians, if you're talking over the phone or whatever, or buying through the internet, as soon as you hear your accent, you can't really disguise you from the other side of the world. And they know you don't know the local area, you're likely to pay more, you're likely to not be able to have property managers you can trust. You'll get things like where agents will sell your property and tell you it's tenanted, and 3 months later, you're not getting any rent because they've paid rent for 3 months. There is never was a tenant in your property. Things like that. There's all these things. Or you're buying the wrong area, or the place is destroyed on the inside, you can't get a tenant. There's all these things that can go wrong. If it's in your local backyard, you can check on that, or you just know the suburb, okay? So there's a lot more research and due diligence needed. So the average person, my answer would be this: unless they get themselves educated and do a course or something and know how to do it themselves, or use a service, then it's not for the average person. Make sense? Or unless you're a sophisticated investor, I'm going to employ people, go and do the work. Like, I employ people, I fly them over there, and also I have a company that does it for members, so we also have the advantage of that. But as a sophisticated investor, I can afford to employ people to go and do the groundwork so I don't have to do it. But if you're only buying a few properties, you can't afford to do that. And if you're only buying 1 or 2 properties, you can't afford the research and the travel costs back and forth for 1 or 2 properties. It's going to kill your returns. You might get 15% rental returns, but you spend 20% of it, or more than that, just going back and checking on things. It defeats the purpose. Make sense? So they'll talk about tomorrow. Lou will talk about tomorrow those who want to be educated about the US property market. They will teach that in the session tomorrow, how to go about that if you want to do that. Certainly if you're going to use a service or educate yourself, then it does become a possibility. Back to what I was talking about. Professor Stephen King. Property market going to crash 40%. In 2008, I said it wouldn't, and hindsight, as we went on, it didn't. Rose 18% in Melbourne. The question is now, Jamie, it's 2000, what is it? Almost 2012. What do you think is going to happen with Australian property? Repeat after me. Something to think about. Who actually cares? Who wants to know? Okay? Because it does affect us. Now, no one knows. However, here's my view. Well, you don't have to take my view. Just figure it out for yourself. So, what I wrote earlier this year, and I still say it, is I said I'm no longer bullish on Australian property. I said I believe it's had its best years. In other words, we've seen massive growth over the last 20, 30 years. It's made a lot of people millionaires, including myself. We don't want to be too greedy and expect it to always do that. I think the consensus would be you would not expect in the next 10 years property to rise as much as it has in the last 10 years. We could be wrong, but I wouldn't be betting on it. I would suggest it's more likely to see some slow to moderate growth. There'll be certain areas in Australia that will outperform. Mining towns, regional cities that are growing, certainly areas that will see significant booms because massively rising population, etc. There'll be other areas that will pull back, that won't grow much at all, or you'll see a drop back. But overall, you'll still see, what do you have moving forward? Population growth in Australia. Is it still rapidly growing, yes or no? Yes. So that will either suggest probably won't see a significant crash. So Harry Dent was out here last month. We had him speak at the Financial Education Summit. And I agree with Harry on a lot of things. I didn't agree with him on he believes, you got to remember when people say some of these things, they're after headlines, okay? It promotes what they do. Harry's an author, so promotes his books. He was out in the paper. You've probably seen a lot of the headlines when he was out here, is that Australian property price is going to crash 40%. I said to Harry, I've heard this conversation before, and I said in defence, here's what I would say. In actual fact, the Australian property market in certain places has crashed as much as 40% in the last 2 years. But it hardly makes the paper. We live in a city right now. What city are we in? Gold Coast. There is property priced in this city, especially the top end of the market, that has crashed 35, 40, 50%. Mansions that were once $5 million, you can now buy for $2 million. If you want to buy a mansion, where should you buy it right now? Gold Coast. It's half price. Okay, Sovereign Island probably even more than half price off. Okay, so we are talking why Gold Coast is a typical US market. It's a Miami. Sunshine Coast the same. It's a Las Vegas. Does it make sense? So in America, the cities that come down the hardest were Las Vegas, Miami. The other one was Phoenix. Okay? Out of those three, the one that's best investing, I'd say, is Phoenix. It's got bounce back potential. Why? Because it's a strong economy and growing. Vegas and Miami, holiday markets, a lot of apartments, high condominiums, etc., particularly Miami. So it's a boom-bust cycle. Gold Coast is a boom-bust cycle. What is the first, in a credit crisis, what is the first thing you sell? Your family home or your holiday home? Holiday home is the first one to go. Sovereign Island homes, Gold Coast, first ones to go. Noosa, the same thing. Noosa peaked in about 2005, 2004, has had minimal growth since. At the top end we're talking about here. So here we have, so to some degree, what Harry's talking about, and Professor Stephen Keen property dropping 40%, in some aspects, if Stephen Keen had said it will drop 40%, but in places like Noosa and the Gold Coast, he would have been right. He was predicting that across the board. He was wrong. It only happened up here, and it already has happened, so I don't see it happening anymore. Gold Coast, I believe, is getting close to bottoming, especially at the top end. Apart from apartments, I would never touch a Gold Coast apartment in my life. The worst investment in the country. And where do most punters being sold investments in property? They don't get educated. They don't go and invest in their education. But if they go along to what they think is a financial seminar, there's not as many these days, but remember the negative gearing seminars? They think it's an education seminar. It's not an education seminar. It's a sales seminar. It's purely there to sell you one thing, flog you an overpriced Gold Coast property. Who knows people that went to those seminars? Who knows people that bought properties through those seminars? Anyone intimately? Okay. Now, in hindsight, even this is how good and forgiving property is. Wind the clock back 10, 15 years ago, if you knew nothing, you went to that negative gearing seminar and you're flogged an overpriced Gold Coast property. In hindsight, if you stuck it out, you still would have made money, even though they were inflating the prices by 50, 70,000, because property's been that good. Okay, and then a lot of people that hung on for 8 years or something, then sold it, and then properties took off. They would have been better off either selling it straight away or not buying it or just staying in the investment. Long term, they still made money in a lot of cases. So there's certain markets you don't touch for that reason. Okay, so I'm sorry if you own Gold Coast apartments. Okay, not saying you couldn't have made money in the past, but they're not the best investment. Okay, you're going to look for the best investment return. So my viewpoint is slow to moderate growth for the Australian property market. Certain areas will be bullish and do quite well, i.e. regional centres, top regional centres that are growing, and certain mining areas which already have grown a lot. But I'm not expecting to get the doubling of property that we've had in the past. Therefore, I've stopped buying Australian houses. Does that say that you should stop buying Australian houses? No, if you're just starting out, there's a great incentive to buy Australian houses, and that is what? Well, you're not going to use much capital growth now, but what's the other reason you buy Australian property? Negative gearing, tax. Jot this down. Rip off the tax department legally. How to rip them off legally? They'll let you do it. They'll send you to jail if you do it illegally, but if you do it legally, it's okay. Negative gearing is the greatest tax scheme ever invented. If you're not negative geared, you're crazy. You're paying all these taxes. Who here has a negative geared property? Okay. Why do we have that? Because it's such an attractive thing. Now, in the country's interest, negative gearing really should be abolished or pulled back. Now I'm a property investor. I'm not meant to say that because it's been in my interest and others to make a lot of money from it. But the country can't afford negative gearing. It should be changed. It distorts the property market. Okay, but you know what happened last time they tried to remove it. It's not likely to be removed in the short term, but long term, I think it will eventually be removed or restricted because the governments won't have a choice, won't be able to afford it. Okay, but wherever it's there, take advantage of it. Negative gearing for that reason. So if you've never invested in one or two properties, it still probably doesn't hurt. Buy in smarter areas. You'll still get slow to moderate growth, but you'll get tax benefits. What I also do, what I changed to this financial plan, is I added here not only US property to diversify, I already have Australian houses as a portfolio. The other thing I do is rural property, but that's not really something that's replicatable for most people because it's the commercial farms. You need managers and you need to know what you're doing. And plus you need millions of dollars. So that's not replicatable. The other thing is land. Land as an investment. Now, if you know about land, is that if you want to say, actually, I talked about this on my blog recently, but if you want to know how big money is made in this country and still is made in this country, jot this word down. It's called land banking. Land banking is probably the biggest way that the super rich in this country have made, we're not talking millions here, but billions. And it's one of the greatest price manipulation schemes that I've ever saw, and it's perfectly legal. You see it happening every day, and people just don't know how to take advantage of it. What do I mean by this, land banking? Is that all the large property development companies, what they do is they buy the farmland around the outside of cities, is it true? And then they get the rezoning to residential land, and they carve it all up, what was big acres, and they carve it up into small blocks. Does it make sense? And then do they sell them all in one go? No, they stage release them. Price manipulation. Have you ever noticed that just wait, I'll get the next phase, it'll probably be cheaper? It's never cheaper. You will never find, I don't think in the history of residential land in any capital city that phase 2's ever been cheaper than phase 1. It's total price manipulation, but you're allowed to do it. So the developers release the first stage at, say, in a capital city now, you're probably paying, $200,000 or $300,000 for a block of land. It might be $200,000. Next stage, $250,000. Next stage, $300,000. Next stage, $350,000. $400,000. Imagine being part of an investment strategy where you automatically know the price is rising because they set the prices. They're price fixers. They're not price takers. And if there's not enough demand, they just slow the release down. They don't lower the price, they just slow the release down. So it's almost like a monopoly. It's a system that makes large development companies billions of dollars. That's why most of them are listed on the stock market, because they're worth a lot of money. Now, what helps with them making billions of dollars is an inept government policy system, which creates the housing shortage to some degree. They don't allow enough release of land fast enough, because one, governments don't have enough money, councils don't have enough money, so they have to rezone too much land. They have to have the money to fund the roads and all that sort of stuff. So infrastructure, so that's one thing that holds it back. So you have inept, incompetent government policy, which pretty much as a land developer makes you money, even though you pay a lot to develop the land. And then you have a monopoly of the banking system controlled by the top 4 banks. If there was a property crash in this country of epic proportions, of 40% plus, it no longer would be our problem. Whose problem would it be? The banks. It would be their problem. So do you think the top 4 banks don't have highly paid research analysts? If you want to follow the property market, the most accurate information is the bank reports on the property market. They're usually the opposite of what the media tries to tell you, but Westpac banking reports, etc., on the property market, they're usually very accurate. And they also were the same. They didn't agree with Professor Stephen Keen, etc. They have a vested interest in the property market. So is it possible that if there's likely to be a property crash, the banks can just turn off the finance tap, yes or no? They control and manipulate the amount of credit allowed for housing, so they can, to some degree, control the market. They don't want it to take off too rapidly. If it is, they'll turn the tap off. and they want a gradual growth because it's in their vested interest. So here is like with land, it's almost controlled to some degree by the banks because the banks want it to continue to rise slowly over a period of time. It's in their interest to do that. So now, you've all heard stories of people that bought some coastal land 30 years ago and then sold it off to developers and made a fortune. Now that's one of the biggest ways people have made money. You say, well, that's great. It's too bad, Jamie. I wish I'd bought land 30 years ago. Now, the downside of land is you generally have to have a 20-30% deposit. Is that true? And you can't generally negative gear it, and you don't have an income unless you put a few cows on it. Okay? So they're the downsides. And it's hard to get money for it. Yeah, and GST and all those things. So that ruled it out for most people. But later tonight, those who are interested in land, as far as, land tends to appreciate much faster than houses. Generally houses depreciate in value. It's the land that goes up in value, okay? So for those who want to find out about a particular strategy, tonight after dinner break, they'll be teaching a strategy on land banking. How can effectively retail investors access what land developers do, but without the outlay, without having to borrow money, without having to have interest costs. Because if you borrow money going through a credit crisis, can you be nervous, yes or no? Yes. You should be nervous, okay? But if you can go through a credit crisis with an investment strategy where you don't have to borrow money, so your downside is limited, you're not tied to having to fork out money to keep an investment going, then you can eliminate most of your downside. But you can still partake in the upside. It's a fairly unique strategy. Retail investors can't access it, but the strategy we're talking about is available to X amount of people, and it's probably the first time it's ever been available to retail type investors. Okay? But it's something that I do personally. If you want to learn how that is done tonight, we'll teach you about that. Okay, does that help you answer what my views are on the property market? Yep. Okay, quickly turn to the person next to you and just teach them what's likely to happen in the economic global update. Go for it. If we want to be better than the economists, all we have to do is use common sense, look at the fundamentals, and figure it out. It's like a multiple choice, isn't it? To go, okay, what's likely to happen? Doesn't give us a crystal ball, but jot this down. What you're looking for is you want to be able to preempt the future. And understanding fundamental analysis is helping you preempt what is most likely going to happen. Okay? That way you don't get caught up in the greed and the fear and the misinformation in the papers, okay? Most information that's given to people is what we call, jot this down, bias information. If you read the paper, it'll often be financial commentators, which generally are financial planners. So of course the information is biased. They're trying to flog a particular investment sector. Or it might be stockbroking analysts, okay? They're going to be talking the stock market up. Or it might be real estate commentators. And what are they going to be talking up? The property market, okay? So it's so much biased information. It's very hard to get unbiased information, okay? Education is one of the few unbiased informations, okay? If I teach you how to invest successfully in the stock market, I don't make any money from that. Does it make sense? I'll get paid to teach you that, but I don't make money from you buying shares. I don't have like shares in my company to sell you. Does it make sense? So I'm not biased towards whether you go out and buy real estate or buy buy stocks, doesn't affect me. Does it make sense? Okay? So in the sense, it's very hard to get unbiased information. So most of the commentary in the newspapers is biased. And you'll see it, the papers don't care. Part of the paper will be telling you the property price is going to crash. Another section of the same paper will be telling it's booming. It's complete contradiction. They don't care. They're just in the process. They're selling news, remember? So if you're selling news, is a sensational headline more likely to grab your attention and you'll buy it? So remember what they're selling? They're selling a headline. And that's why you get the exaggeration both ways. It's usually not as bad as it seems, not as good as it seems. It's usually somewhere in between. Okay? That's why you have to be able to decipher information. Now, does it mean you have to know everything? No. Just stick to common sense. Anything we're talking about this weekend is common sense, strategic thinking. That's all we're doing. Let's be smart about what we do. Does anyone have any questions on what I covered as far as the economic update and things like that? Yep, we'll take a couple of quick questions and a couple other things that I forgot to cover on that. Then we'll get into how do we get started with investing. Yep, fire away. Yep.
how do you actually calculate the intrinsic or replacement value with the property? I know that you gave an example, but what I'm thinking is in an economic downturn, it would actually cost less, okay, to build the same house because tradies are willing to work for less, okay? Yep. Basic materials cost less. So you can't actually, when you calculate it, you can't say that this is how much it cost to build back in 2008, therefore that's its replacement value.
Yeah, true. So what you would look at is what it is now, the new homes that are being built. So even in the US, they're still building new homes, okay? They're building about a third of what they used to, okay? So you'd still look at the cost of the new home, the cost of the block, cost them to produce that product, and let's say it has come down, it's only 200,000. And then you would estimate, well, a second-hand home is worth X amount less than that. But you'd still see in there, you'd still have some intrinsic value. Does it make sense?
Don't you think that in a deflationary environment, it will just continue going down all the time as well?
Well, then what you have to take is a view and say, what do you think is going to happen in the US economy in the next 10 years? If hyperinflation kicks in 3, 4, 5 years from all the printing of the money and liquidity, then that could affect that. But that really affects things more overseas. And the value of that asset compared to Australian dollars might go down. Okay, but if the US dollar completely crashed in that sense, but the asset within America wouldn't be affected, okay, because it would still be in US dollars within that economy. Does it make sense?
So when you look, for example, in a place like Phoenix for properties that are selling below replacement value, you would look at how much they're selling, like, how much is being advertised, like a new development or a new, like, I don't know,
yeah, you just see what
condo development or whatever, and that's you assume that that's the replacement value.
Yeah.
Okay.
Well, that's about all you can do. What you can do in this example...
Because it's not like the stock market. You can't actually assess accurately the value of something because the financials are not public knowledge. You can't just take, like, the value of a company, divide by the number of shares, and you get a number.
Okay, what you can do, though, in the stock market is that when we talk about intrinsic value, some companies will trade, obviously, in stock markets, it's often a judgment call, whether something's undervalued, what it's really worth. But in some cases, there's some companies that their physical net assets are worth more than the market capitalization of the company.
But that's very easy to determine with a company, whereas with property, it's...
Yeah, property still, it's what the price of equivalent product is worth to build. Right. So, makes sense. Yep. Now, but in saying that also, you don't, in this example, if you've got a positive cash flow property that's going to pay itself off over a period of time, the intrinsic value, that's a secondary factor. But all I'm saying is that when you buy assets, if you can buy them below what they're really worth, you're going to sleep better at night. You know you got something of value. In the dot-com days, when people are paying sky-high prices for a company that never made money, then they don't have any intrinsic value. When the tide goes out or the trend changes, they're left holding something that's worthless. Making sense? So you really want to hold something that has some real value. Far away.
I'm trying to get right through, especially when you're talking about Vegas and Miami, because I'm from Vegas. Now, I got a call a few months ago from my cousin, just fired up out of his tree. He's like, yeah, mate, took about 40 grand, I had 40 grand saved. He's like, I got 4 properties, Average property he got was 3-bed, 2-bath, pools, paid like 40, 50 grand for him. Just made me want to stab myself because I didn't have the capital to do it. I was so pissed off. So, you just get off the phone like, good for you, mate. And then you're like,
but it's true over there. There's amazing houses you'll see. Some of these houses you'd live in. You can't believe it. They're like, it's like playing Monopoly.
Yeah, it's ridiculous. I mean, he's got tenants in those properties at $900 a month. And he's got mortgages at $400 or $500.
Yeah.
So he's just ridiculously positive. He's got a great passive income already. So my concern is, based on what you're saying, well, there's a decent possibility that it might stagnate the economy, and next decade they're not going to do so well. But due to all the surplus being used up for the next few years and the population still rising, am I safe to assume that if I want to rock and roll and kick some ass in the U.S. market, I've literally got maybe a 3-4 year window before it starts bouncing back, and I got to act now? Am I assuming on the right?
Absolutely. The window is probably not even that long, but the window has extended. If you say 6 months ago, I would have said the window is probably 12, 18 months.
Right.
With the way the world's changed since then, you've probably got a little bit more time. But yes, certainly, you'll see in some places, I think they'll talk about tomorrow, they cover it, but say in Phoenix, they've already seen some price rises off the bottom of the market. And a lot of that is because a lot of foreign investors are buying the stock now. So in some cities, you're seeing the rises. As far as the city long term, once again, if you're getting the cash flow, and remember, capital growth in the US is considered a bonus. If you consider it as a bonus, you don't count on it. then it doesn't matter if you get no capital growth. But if you're in a city that has strong economic credentials, like Phoenix is an example, Arizona. Arizona is a bigger economy than Malaysia and Argentina. Do you realize that? We're not talking a small economy here. And once we've done more research on a city like that, Australians will go into a city in Australia, right, and buy a house and wouldn't even know the demographics or what the workforce of that city is employed in, what percentage in what industries. But when we go to America, we want to know all that. So we do so much more due diligence because we're going into a new area than what we would in our own backyard. So sometimes we overanalyze things, okay? But if you're in a city, it's same as in Australia. Like an example in US property, a lot of Australians have bought into Detroit and Buffalo, and you hear these horror cases of properties they've bought. But common sense would dictate that generally we wouldn't target a city like that, because what's the future of Buffalo? Buffalo is a city that had 600,000 people that shrunk to 300,000. If Gold Coast, 600,000 people, had shrunk to 300,000, would there be some cheap houses around, yes or no?
Yeah.
Would you be going, wow, I'm going to buy here? You'd be going, if the population's shrinking like this, people are leaving for a reason, there's whole suburbs that no one lives in, you'll get a cheap house. No one will rent it.
That's it. 'Cause
Okay.
I was thinking, you were saying, yes, the values there are just insanely ridiculous for value, but
Yep.
for the average Aussie, it's probably not a good idea, because you go to a place like Detroit and you see, oh wow, I can get a 4-bedroom house for 25 grand, and no one in Detroit has a friggin' job, so you're never going to get a renter. So you're just going to be sitting on this thing in your house.
Exactly. So that's where the average person will make a lot of mistakes.
Cool.
And that's why I'd say generally for the average person, no, don't do it. But if we want to be above average and get ourselves educated, put some time and effort into it, or use a service where you're basically paying someone to do it for you,
Because they've
then it
done all the
becomes
research
realistic.
and the diligence, and
Yep.
they've done the hard yards, and I just got to...
Yeah, I mean, Detroit, there's still money to be made in cities like that.
Cheers,
but
mate.
I always joke that with Detroit, unless you want to buy a Humvee with a machine gun turret to collect your rent, there's better things to do. I mean, sadly, I was talking to BRW last week, and I said, did you realise that when I was over there, that an Australian went over to Detroit to check on his property to collect the rent and do some repairs, and he was shot dead. So there's these things that happen. So you certainly, you want to know the suburbs, you want to know the cities, you want to be knowing what you're doing. I'm not saying that to scare you, but I'm saying that you want to be smart about what you're doing. But once again, it's common sense. If you discovered a city in Australia that's likely, say, like a Phoenix, that's a big city, strong economy, likely to boom, has strong economic credentials, and in 10 years is going to be this much bigger, etc., you go, well, yeah, that would make sense in a Melbourne-type city. That's going to happen. Would you go Detroit? Well, what's its main industry? Automobile. It's living on aid from Obama. It doesn't make sense. Okay? So it may turn itself around. There may be bargains in there. The point is that you use common sense and you just stick to the ones that are more likely to succeed. Okay? That's why just buying off the internet can be dangerous, because, jot this down, there's a difference between cheap and intrinsic value. You notice the difference? It's intrinsic value you're after. You're after something that has a future, okay? So, but then it depends on your strategy. We'll cover US tomorrow, okay? I'm a little bit behind on what we meant to talk about today. Those who want to find out about the US, stick around tomorrow after lunch. They'll do a 90-minute session on that. Make sense? What I want to talk about is other things I forgot to cover. What about the stock market? What's going to happen with the stock market before we go into that? My belief is this. I also mentioned this on the blog. My belief is that you'll see right now in the stock market, you will see short-term rises where they think there's going to be some sort of recovery or run out of puff because it's a false hope, and then it'll drop back down. So you try and go again, and that's what's happening. People get a bit of good news, it takes off a bit, and then they realize, well, that's not going to last. That good news is going to come back down. So you're going to see what's going to be happening which is a great strategy we've been teaching for a lot of times, is what the market will do is more likely channel sideways. And that's what you're seeing. True? So there's opportunity to make profit from that, which we'll cover in just a moment. The Australian stock market is still affected by the US market, the sentiment of the world market. So the markets around the world are freaking out with Europe or the US. It'll affect our market even if it fundamentally shouldn't. So that's the problem with the Australian stock market. It's affected by those things. But you can still profit from that. Economically, what's going to happen? Harry Dent even said, I talked about yesterday, that Australia is probably one of the best economies to be in through credit crisis too. I would agree with that. How will we be affected? The fundamentally, we shouldn't be too badly affected. It's more the sentiment. And we talk about the stock market, what do I mean by sentiment? If the overall sentiment or overall feeling is the markets are coming down, it will drag a market down. If the overall feeling is the world could head into a double dip recession, and Europe could face a possible depression or severe recession, then it can drag down, it can create uncertainty, it can drag our sentiment of our economy down. Even though fundamentally we'd be like, well, we've got record investment coming in, we've got hundreds of billions of dollars worth of planned investments from the mining industry coming into this country, that even if some of it drops off, is still coming. So fundamentally, there's a massive amount of money, massive amount of jobs coming into our economy still. So fundamentally, you say, well, we should be pretty fine. There might be some short-term volatility, but Australia, in my view, should boom to 2050 at least. We certainly are in a lucky country. Not always through good management, but more through the fact that we are the size of America as far as natural resources. Australia is almost the size of the United States of America in land mass, yet it has about 7% of the population of the US. So we have tiny population with massive resources. That's why we're sitting on a gold mine. Most Australians just don't realise how lucky we are or how rich we are. And people mope around wondering, I don't know how I can get rich in this country. It's like, yeah, nothing works. Give up, okay? And that's their attitude. They're living on a gold mine. Small amount of people divided amongst all this wealth. We are so loaded we don't even realise. The only thing holding us back being richer is to wake up and smell the roses. This wishy-washy attitude, just get out there and grow the country. Some people are like, well, we shouldn't have a big Australia. Jot this down. Bullshit. Let's make a big Australia. We'll slow down in 20, 30 years when we've made this country so rich and so wealthy and everyone can enjoy the fruits of our labour. Does that make sense? Don't go slow now. It's a once-in-a-lifetime boom. Grow. Open the floodgates. Let people come. Okay, Australians have this anti-immigration idea. Immigrants build countries. America becomes so great, built on immigrants. Name me any country that's done well without immigrants. I say open the floodgates, but let the best people in the world come. To come to this country, if you come from a country like US, UK, countries where people would instantly assimilate to our culture, instantly, very hard to come. Come from a country where you're unlikely to assimilate in a hurry. They'll open the floodgates. Okay? We should pick the best of the best. Okay? I don't know why it is. It's just government policy is always slow to react or adjust, a lot of political posturing. Because if you said, okay, we're going to open the floodgates, let a lot of people in, a lot of Australians would freak out with that and probably vote you out of power. Does that make sense? So there's always things the way that you've got to sell that message. If you're not a politician, you can say it how it is. Is it true? So that's what we should do, because why? Look at the mining industry. It's been held back right now because they can't find enough workers. Sure, Australians should get first chance at the job. No one has an issue with that. Many of them don't want the job. Or many of them aren't skilled enough. Well, invest in training. Train these people. Okay? But let other people in. There are so many people around the world. What you've got to understand is that it's just like with Richard Branson. His policy in business is it's all about team. There's not a lot of difference between companies. Let's say you're flying an airline company. The planes are the same. Qantas, Virgin, they're pretty much the same planes. The only point of difference is the people. Same with the country. To make a country great, it's all about the people. How well skilled the people of our country are, how well trained they are, how well motivated you are, how well are you good at saving your money, how well are you investing and managing your money, how efficient you are at work and at producing things. Social harmonies, all those things are an asset. So if all Australians were as motivated as you guys and driven as you guys and as smart as you guys and focused, this country could double its productivity. Does that make sense? But because there's some people that are really switched on, some people that just in the middle, and then you've got people that really drag the chain, don't want to work, couldn't be bothered, think the country owes them a living. So you've got a combination of all these things. But add all that up and that's the output of the country. So those things, what I'm saying is the good news is this: we're very fortunate. Let's not abuse that good fortune. Let's make the most of it. And let's really be, I think we should be bullish about our future economically. You know, where else would you rather live? Does it make sense?